The International Monetary Fund has raised another red flag over China. Overnight, it cut its global growth forecast for the second time this year to just over 3%. The IMF is blaming the well-documented slowdown in China and the commodities crash. The bleak assessment comes at a bad time for China's property sector. Land sales are down 30% this year as developers hold back and prices tumble. China correspondent Hui Feng-Tay reports from Beijing.
It's been called the Great Leap Forward in commercial real estate, a decade-long development frenzy in Beijing and beyond. But the sun is now setting on the building boom. Once, selling and buying land to build apartments, offices and shopping malls seemed a sure way to make money. No longer. Competition between developers is intense, and tenants of some shopping malls are dictating terms.
It was the luxury brands who started the trend of asking developers to foot the renovation bill for their stores. Then mid-range labels and restaurants started doing the same.
The cooling of construction is playing out differently in Tier 1 and 2 cities. China's smaller cities are struggling to attract tenants for office and retail spaces. Rents have fallen, and office vacancy rates can be as high as 38% compared to 6.3% in a city like Beijing.
In response to the situation, some landlords of the future office buildings are likely to postpone their completion periods, and the landlords of existing buildings, they are likely to lower the rents.
Property analysts' forecasts for China's major cities are still optimistic, but Asia's richest man, Li Ka-shing, does not seem to share that view. He's been trimming his property portfolio in China's big cities since 2011, cashing out after riding a wave of unusual growth. Mr. Li's money is currently in Europe's ports, water and telecommunications companies.
Mr. Li's companies like Chung Kong and Hutchison Whampoa have the resources to do well in this area in China. It's not a problem, but we don't see him developing in this area. Perhaps he has other considerations for selling.
Australia's Reserve Bank believes China's property market will remain weak for a while. Developers in China seem to see it the same way. Official figures show land sales have fallen by 32% in area and nearly a quarter in value compared to a year ago. More and more Chinese real estate companies and institutional investors are looking offshore to the US and Australia for growth.
It depends. For multinational institutional investors, they are more conservative for the activity in Tier 2 cities due to the risks, but they are still eager to seek for opportunities in Tier 1 cities. But the problem is the availability, whether they can find opportunities, especially in Beijing, the liquidity is still low.
Weaker conditions in the property market are likely to constrain Chinese growth, with implications for the Australian economy. Investors are adjusting their expectations in the twilight of one of the most extraordinary building booms in history.